or get a mortgage for a home that I'm buying on reserve, you would go through your band office and go through their individual housing policies. And then there's also a ministerial loan guarantee program, which is basically RBC grants the bands a lump sum of money, and they're basically able to divvy it out to each individual band member based on how they want to operate their housing policies. So as far as like individuals needing to learn about First Nation mortgages, we don't do them in the branch. Like I said, it's something that the band would negotiate with the banks, and then they would negotiate based on their housing policy with the individual band members. So I'm going to talk a little bit about credit basics, and then I'm going to hand it over to Petra to talk about mortgages specifically. So when we are doing a credit application, so regardless of what it's for, whether it is a student loan, a mortgage, credit cards, a car loan, anything like that, we do look at what we call the 5 C's of credit. So it's basically someone's entire credit picture. So we look at their character. So do they have stable employment? How long have they been at that type of employment? Is it stable as far as being full-time? Is it part-time? Is it seasonal? Have they already established a saving strategy? And how long have they been a client of ours? So people talk about, I've been with the bank for X number of years. That it does matter because we're able to see how well you're able to manage your finances. Capital, so basically your net worth, how much you owe versus how much you own. And is that net worth positive? So do you have a ton of debt, but you have no assets to show for it? Or do you have a ton of debt, but you have a bunch of assets that will kind of cover off the value of that debt that you have? Your capacity, so basically, how much can you afford to take in on credit? Can you afford a $100,000 mortgage? So all of your income coming in versus the debt that you're paying out. We never want to put a client in a situation where you can't afford to pay your bills because we've granted you too much credit. So that's something that we look at as well. Your credit history. So have you had credit facilities in the past? So did you have that small student credit card when you first went to university? And how was your payment history on that credit card? A lot of times when we're looking at applications for mortgages or car loans down the road, it's really important to know that anything that you do the minute you turn 19, so whether it is a cell phone bill, a small credit card, a car loan, anything like that, that you're paying those on time every month. Because if the amount of credit history that you have is very limited, that's what we have to go by. So just make sure that you're making your payments on time, because late payments on those things will affect your credit facility and your credit, what we're able to do for you in the future. And the number of credit bureau reports affects it as well. So if you are looking for a car and you're going from dealership to dealership and you're shopping for cars, don't let every dealership run your credit. Find your car first and then go through with your credit process. Having multiple hits on your credit bureau could negatively affect your credit depending on your situation. So that's something that some people don't realize it does. I see, Leanne, you have your hand up. Do you have a question?
Sorry. So I was just, when you said that, I'm thinking like when I was going to purchase my first vehicle, I needed a co-signer, and I'm sure a lot of people would probably be in that boat too. So I was just wondering if you could also mention that co-signer position too in the process of building that credit.
For sure. So a cosigner, basically the way that you want to look at it with a cosigner and the way that the bank would explain a cosigner to them is that they're responsible for this debt. So the applications are likely going to be based on the cosigner's 5 C's in that situation. So whether it's a student loan or a car or whatever, we're looking at how strong is that cosigner. And they need to be fully aware that if you default on whatever type of loan or credit that you're getting, they are fully responsible for it. And they're usually not able to come off as a cosigner until you're able to fully qualify for the product on your own without them in the future. So sometimes you hear like, oh, get a cosigner and then come back in 6 months or come back in a year and we'll take them off. That's not necessarily how it always works. You have to be able to fit the 5 C's and qualify on your own without that cosigner going forward. So definitely if you're going to be a cosigner for somebody or get a cosigner, you want to make sure that it's somebody that you're definitely comfortable with, and that they understand or you understand that basically, you know, you're a co-owner of this debt and you're ultimately responsible for it. Does that help?
I have a question.
Sure.
When it comes to the whole like paying your phone bill on time and stuff, will they look into it if, let's say, you're on a plan with your parents and it's not specifically under your name? Is that directly going to affect your credit, or is that their credit?
No. So whoever's credit bureau is on, it would affect their credit. So if it's your dad's credit, your dad's cell phone bill, and you just have an extra line and you pay it to dad and dad pays it every month, then that's not going to negatively or positively impact your credit bureau at all. Okay. And then collateral. So collateral is mostly applicable when it comes to mortgages, because the home that you're purchasing is held as collateral. A lot of times in vehicle loans as well, you will see the loan is the vehicle is held as collateral for that loan. When it comes to credit cards, student loans, stuff like that, those are types of credit facilities that we don't often hold collateral for. There could be a rare circumstance where we would, but most of the time, a loan, credit card, something like that, there's no collateral. So this would only really be applicable for mortgages or vehicles, or like an RV loan or something like that. So I'm going to hand it over to Petra to really get into the mortgage side of it. Now that you guys kind of understand the basics of credit, which is applicable to any type of credit application and the things that a bank would look for, Petra, as a mortgage specialist, is going to really dig into, you know, getting ready. How can you afford it? How much can you afford? That type of thing. So take it away, Petra.
Perfect. Thank you, Alex. Before I actually jump into the mortgage piece of it, I just kind of wanted to mention a couple of things that Alex was talking about in regards to your credit and how your credit can be affected. So anytime that you are looking at doing a pre-approval or purchasing a property, you have a credit score, and we have a minimum credit score guideline that we actually have to follow. So the minimum credit score guideline that we have to follow when you are purchasing a property is 650. So it needs to be at least above 650, and you require at least 2 credit products in good standing for 2 years. So they want to see, you know, if you're looking at taking on this $100,000 debt, do you have previous credit history showing that all your bill payments are made on time? And your credit score will fluctuate over time. So the highest credit score that you can have is 900. Usually we don't see a lot of 900 credit scores. Generally who we see with the 900 credit score is somebody who's freshly 19, you just got your first credit card, you've made all your payments on time, or somebody who's retired, all of their previous credit was all paid on time. They don't really have a lot of credit taken out, but your credit will fluctuate over time. And it's not bad if it's moving, because different things are going to affect your credit score. So as you take on debt, as you pay back debt, that is going to affect your credit score. But where you really want to stay is at least above 650, and anything in the 700-800s is absolutely excellent. And just a little kind of tidbit of information when it comes to phone bills. If you have a phone bill and it's reporting to your credit report, if your phone bill is $81 and you pay $80, that $1 will actually go into 30 days late. So we see a lot of late payments when it comes to phone bills. So that's something that you might want to take into consideration, is making sure that you're making your payments on time, but then also when it comes to phone bills, making sure that you're paying the full balance on it as well. So just a couple of little pieces when it comes to the credit portion of it.
Thank you for sharing that. I did not know that.
A lot
Darn
of
phone bills.
Yeah.
God.
And
Okay.
it's scary how many clients that we have a good relationship with that sometimes a deal for credit is out of our hands because of something like that, where their credit is be affected. And it's like, wow, it's only $1, it's only $2. I just rounded up or I rounded down on it. And I didn't realize that it's negatively impacting me that way. So it's definitely important to pay attention to that.
That's awesome. Thank you, guys.
And sorry, Petra, but before you go ahead, and I don't know if any of you are RBC clients, but if you are and you're over the age of 19 and you have an RBC bank account and online banking, you can actually check your credit score for free on there without actually applying for anything. So you can sign into there. It will tell you where your credit score is currently, all the products you currently have, and then it'll also give you tips on how to improve your credit score. So like Petra was talking about, if you're in the 600 range and you know that you have to get to 650, 700 to get a mortgage, and you want to work there, the the app on the online banking site will walk you through what you can do to help improve that score.
Awesome.
So it's right on the app, right?
Yep. So you can either log in on your phone and just on the, I think you would have to do it through Safari if you're on an iPhone or if you're on a tablet. But on the right-hand side, it would tell you to, like, check my credit score, and it's a soft, it's a soft hit on your bureau. So there's no negative impact of using it, but it's a free service. And then you can also do it on a laptop as well. If you have a laptop, it's a little easier to see, but yeah, for sure.
Okay.
All right.
Perfect. So we'll jump into a little bit more about mortgages and borrowing for mortgages and how they actually work. So the first slide that we have on there is kind of getting ready to purchase a property. So there's lots of things that you can do to actually get yourself ready when it comes to doing a mortgage pre-approval or getting yourself, you know, where you want to be when it comes to purchasing a property. One of the biggest things is knowing how much you can afford and what it's going to cost for you to save to be able to afford that property. So anytime that you purchase a property, the minimum down payment that's required is 5%. So if, for example, you looked at purchasing a house for $100,000, your minimum down payment that would be required would be $5,000. So it's always based off the purchase price, but it's always a minimum 5% down payment. There are two types of mortgages. So there's a conventional mortgage, and then there's a default insured mortgage. And really the only difference is how much you're putting towards the down payment. So if you do anything that is less than a 20% down payment, it's considered a default insured mortgage. And all that's really different there is there's an additional insurance premium that's actually tacked on into your mortgage. So you don't pay for that cost up front. And I'll kind of explain a little bit of who they are. So who they are is banks used to only lend to people if you had a 20% down payment and nobody could afford it. So the government said, we need to stimulate the economy. What are we going to do? So they put this insurance in place that actually protects the bank. So if you default on your mortgage and you don't pay it, the bank has so many days to take over your property and try to sell it. If the bank can't sell your property within 90 days, then the insurer takes over the mortgage from the bank and then they try to sell it. So their fee is 4% and it's tacked on into your mortgage. You don't pay for it up front. But the only way that you can ever avoid that 4% premium is if you have a 20% down payment, which would be considered a conventional mortgage. Don't worry, don't panic on that. Most people who are purchasing a property only do a 5% down payment. So a lot of the times when people are purchasing, you know, maybe their second property or they're selling a house and purchasing another property, that's when they'll usually do a 20% down payment. If you can save and get yourself a 20% down payment, it absolutely does save you a lot of money in the long run. But the minimum down payment that's required is 5%. So working towards saving towards your down payment is really going to help in the purchasing stage. So a big piece when it comes to applying for a mortgage is knowing how much you can afford. So the banks are government regulated to follow a guideline that's called your debt servicing ratio. So that's based on the income you have coming in versus the debt that you have going out. So your income that you have coming in would be your employment. So if you're working full-time, you're working 40 hours a week, making $10 an hour, that's going to be the income that you have coming in to support any debts that you might have. Any debts that you have would be like your mortgage payment, your property taxes, your heat. If you have any car loans, any student loans, any credit cards or lines of credit, that's what we're going to be looking at when we're calculating your debt servicing ratio. So you want to make sure, and the bank wants to make sure that you can afford the mortgage payment that you're taking on. So, you know, if you make $1,000, let's say $1,000 a month, you don't want to take on a mortgage payment that's $1,200 a month. So we want to make sure that you're going to be able to avoid or afford that payment. So that's where we follow your debt servicing ratio. I think too, when it comes to knowing how much you can afford, a big piece that you want to take into consideration, especially when you are purchasing a property, is you want to be very honest with yourself. There's a lot of calculators that you can actually use online that will show you, you know what, how much you're making off your paycheck, how much goes towards credit cards, how much goes towards loans, how much goes towards a mortgage. But I think it's important when you're buying a house is you don't want to be house poor. So you want to take into consideration, okay, you know what, I spend $50 a month going out to eat at restaurants, or $50 a month going to the movies. So you want to make sure that you still have a little bit of available cash flow to be able to, you know, do those entertainment things. And then also, you know, your everyday household items like your shampoo and your toilet paper. You want to make sure that you can afford all those items as well too. So if you ever use any of those calculators online that show you how much you can afford, or a budgeting tool, I tell clients to be very honest with yourself, so that if you're spending money going to a restaurant, you want to make sure that you're adding that into the budget calculator. So there's a couple of spots where you can actually save when it comes to saving for the source of your down payment. You know, you can look at putting it in a regular, just day-to-day savings account. You could look at utilizing a tax-free savings account. So with a tax-free savings account, you would be previously taxed on any money that you would have earned. And then the money that you're putting into your tax-free savings account is actually earning interest. And then you don't get taxed on any of the funds that are going in there. And then you don't get taxed when you take out of your tax-free savings account. So the big thing with the tax-free savings account is it allows you to put a regular payment into that account. So if you said, you know what, I want to save $50 every 2 weeks or $100 every 2 weeks to be able to save towards my down payment, that's an excellent spot for you to kind of tuck some money aside and completely forget about it. Another option that you can potentially look at is a registered or an Rrsp, so a registered retirement savings plan. So sometimes you'll actually have an employer who will contribute into an Rrsp. And when you're doing that, you can take the money out of your Rrsp for first-time home buyers, and you don't get taxed on any of that money when it comes out of that plan. So that's one of the benefits for first-time home buyers, is taking out of your Rrsps. Same thing, you can set up a regular scheduled payment into that account as well too. It doesn't need to be with an employer. So if you want to put $50, $100 every couple of weeks into an Rrsp, that's an excellent opportunity for you to save some money as well. The other option that you can potentially look at when you are purchasing a property is generally when it comes to your down payment, those funds need to be in your account for 90 days, building over time to show that it's legal money. Or the other option is those funds can actually be gifted to you as well. So if an immediate family member wants to gift the source of your down payment, there's an additional form that they sign and you sign saying that they're gifting you the money for the down payment. If you win the lottery and we can show confirmation of where that money came from, or if you inherited funds, we can show where that money came from, then we can use those as well too. But I think the big thing when it comes to building and saving for your down payment is really setting up a regular plan with so much money going into an account, keep it out of sight, out of mind, so that it's starting to build over time.
I'm just going to circle back really quickly to RRSPs as well. For anybody who is Indigenous and is working on a reserve, the RRSP option may not be the best option for you depending on your income tax situation. So when you're talking about options, definitely just sit down with an advisor. Regardless of what bank you deal with, they are going to have financial advisors who would be able to tell you what the best option is for you. Because I know that when I was working on reserve, I didn't have to pay income tax on my paycheck because I'm Indigenous. So the RSP wasn't the best option for me. I was more suited to go with a tax-free savings account just because I wasn't paying income tax on my paycheck anyway. So there was no benefit of me using the RSP at that time. So just if you do want to set up a savings plan, regardless of what option, just make sure you're sitting down with somebody and not just opening something up based on what we're talking about today, that you want to get tailored advice that's specific to you and your situation.
Yeah, like how Alex mentioned, the tax-free savings account and your RRSPs, you have to be a licensed investment person to be able to open up those accounts. So they're going to give you better advice. I'm not a licensed representative, so I can tell you a little bit about it from experience, but somebody like Alex, who is licensed, or somebody at a different financial institution who is licensed, would absolutely be able to give you a lot more information when it comes to those type of investment accounts. So I'm going to dive into this one. So there's a lot of information when it comes to the closing costs and the additional costs associated with purchasing a property that a lot of people are unaware of. So I previously mentioned a little bit about the down payment. So anytime that you purchase a property, the minimum down payment that's required is 5%. So if, for example, you're looking at purchasing for $100,000, you're going to need a minimum of $5,000 for your down payment. You'll have lawyer fees. They're usually about $1,000. Most of the lawyers around here are all relatively priced the same. You can call different law offices to see who's going to give you the best price, but they're all relatively around the $1,000 mark. Home and property inspection, the bank, so RBC actually doesn't require one, but I do highly, highly recommend them. They're usually about $300 or $400. And the last thing that you want to do is purchase a property, $100,000 mortgage, and then find out down the road that there's major issues associated with that house. So it's better to do the inspection ahead of time, find out if there's any issues. They can also be really good for negotiating as well. So if you put an offer in on a house and you offer $100,000 and then you find out it needs all new windows or it needs a new roof, they may either lower your purchase price a little bit, or they might actually do the work prior to you moving in. So they're not demanded by the bank, but I do recommend, you know, taking that extra $300 or $400 and putting it towards a house inspection. You may have moving costs. So if you're, you know, you need some help with moving some of your furniture, you may have moving costs associated with that. Property survey. So when it comes to surveys, you have two options. You can look at either title insurance, which is usually about $200, or you can do a brand new survey, which is closer to about $800 or $900. And essentially what that is title insurance is kind of taking over the previous like land markers that the previous owner had, where a survey would be doing a brand new plot plan. So saying that your land is from point A to point B. Your lawyer will help you make that decision. That's not something that you need to come up with on your own. That's something that they'll actually walk you through, but it is a closing cost associated with it. You'll have land transfer tax. So what that is it's considered a D transfer tax. So in the CBRM, it's 1.5% of your purchase price. So if you looked at purchasing for $100,000, your D transfer tax is $1,500. And that just goes to the municipality. So it's kind of just CBRM's way of getting their piece of a pie when a house does sell. That one's probably the worst cost associated with purchasing. Title insurance, we already talked about a little bit with the survey. You'll have disbursements. So what they would be is kind of like property adjustments. So that would be like if you bought a house from me and I just filled my oil tank, I want to be reimbursed for the oil that I put in there. Same with my taxes. If I paid my property taxes for the full year and you move in at month 6, I want to be reimbursed for those other 6 months. Your lawyer figures out all of those costs for you. You may have utility hookups, so like your Nova Scotia Power, your Bella Lion, things along those lines when it comes to setting up those utilities. Another thing that's actually not on here that it's important to take into consideration as well is proof that your property is insured. So your lawyer will look for confirmation that the property is insured upon closing. So generally we tell clients you need 5% for your down payment and then about another 3 to 4% for the remainder of your closing costs. So this one is a little bit different. So we're going to talk about amortization and term. We're going to talk about what a fixed rate is, what a variable rate is, what an open mortgage is, what a closed mortgage is. So this is lots of terms that when people talk about mortgages, they may not fully understand what all of these terms mean. And these terms might not mean the same for you as they do for somebody else. So mortgages, there's lots of different mortgage options that are available to you. And sometimes, how long I want to take a mortgage out for might be a little bit different than how long Alex wants to take a mortgage out for. So talking to a mortgage specialist, having a conversation, deciding, what we're buying the house for. Is it for personal? Is it for an investment? That can determine what is going to be the best mortgage option for you. So when it comes to amortization, that is how long you're taking your mortgage out for. So most people, when they purchase a property, they take the mortgage out for 25 years. Some people, if they want to look at paying their mortgage off quicker, they may take it out for 20 years. The only time that you can ever take your mortgage out for 30 years is if you have a 20% down payment. So most first-time home buyers, when they're purchasing a property, they'll take their mortgage out for 25 years, and that's where your payment is going to come from. So if you take it out for 10 years, your payment is going to be higher, but if you take it out for 25 years, your payment is going to be lower. So your amortization is how long you're actually taking that mortgage or loan out for. A term is how long you're locking in your interest rate. So a lot of the times when people purchase a property, they always ask, what's the fixed rate? So the 5-year fixed rate is how long you're locking in that interest rate. So you're locking it in for 5 years. There's lots of different terms that are available. There's 1 year, 2 years, 3 years, 4 years, 5 years. Most commonly 5 years is, the most common one available, but the term is how long you're actually taking the interest rate out for. Different types of interest rates. So there's a fixed interest rate. So if you lock in your interest rate for 5 years, that's a fixed rate. It means you're guaranteed that interest rate for the 5 years. In 5 years' time, your mortgage will come up for renewal, and then you'll renegotiate that interest rate. But a fixed rate means the interest rate is the same. You don't have to worry about the interest rate changing at all. Where a variable interest rate, the interest rate actually fluctuates over time. So it's based off the prime rate. So if the bank's prime rate goes up, then your interest rate goes up. If the bank's prime rate goes down, then your interest rate can go down. Most people are comfortable with the fixed rate term because they know the interest rate is going to be the same for 5 years. But a variable term has actually outperformed the fixed rate term in the last 10 years. But a lot of people aren't comfortable with it because it does fluctuate over time. Then there's different types of terms. So if you look at an open mortgage, that just means you can pay your mortgage off at any time. Where a closed mortgage means if you were to pay your mortgage off, you'll have a penalty associated with it. So most people go into a closed mortgage. The only time people usually go into an open mortgage is if they're planning on paying it off. So if you said, you know what, I'm putting my house on the market, I'm going to sell it, my goal is to pay off the mortgage, a lot of people will go into an open mortgage at that time, or if you're planning to win the lottery. But most people will look at a closed mortgage. So just a couple of tips when it comes to buying your first home. So one of the things that you really want to take into consideration is doing a mortgage pre-approval. So sitting down with somebody like myself, a mortgage specialist, having a conversation with them, going through doing an application. When you do a mortgage pre-approval, it allows me to answer any questions that you might have. It shows that when you're looking for houses that you're more serious as well too. It also allows you to know how much you can borrow ahead of time. So you might want to go look at houses that are 200,000, but you might only be able to only afford 150,000. So it gives you a price point of how much you can actually look at. Another thing that is really good is it holds your interest rate for 120 days. So anytime that we do a mortgage pre-approval, it locks in the interest rate based off that day. So if the interest rates were to go up, you're still guaranteed that lower interest rate for the 120 days. It also allows me to give you some information in regards to documentation that will be required when you do put an offer in on a property. Another thing that's really good when you do go through and you do a mortgage pre-approval is there's kind of a misconception when it comes to realtors. A lot of people think when they're looking for houses, they have to call the realtor that's actually on the sign, where you don't. You can actually contact any realtor and any realtor can take you to see any property. It doesn't cost you anything. to work with a realtor, the person who's paying the realtor is actually the person that's selling the house. So meeting with somebody like myself, I can actually refer you to a realtor so that they can take you out to look at properties. And especially, I'm not sure if anyone is aware, but right now the market is crazy. There's lots of houses that are being sold. They are being sold within a day. There's bidding wars going on houses. So it's really important to work with a realtor. So if I'm working with a realtor, they know Petra wants a house in the Sydney River area. She's looking between 100 and 150. She wants 3 bedrooms and a big backyard. So they know what houses are coming up, which is just a really good opportunity for you guys to kind of get to know somebody, and they can help you out when it comes to navigating the market as well. So there's lots of tools that are available to you through online banking. If you simply search, you go into Google Chrome and you search RBC mortgage calculators or RBC budgeting tools, they're all through your online banking as well too, but there's lots of tools to kind of help you out. If anybody's interested, has any questions, you can certainly always reach out to myself as well. Couple of tips of how you can pay your mortgage off sooner. So there's additional prepayment options that are available to you. So you can always increase your payments by 10% every year, which isn't much, but adds up. You can do a 10% anniversary payment every year as well too. And it's 10% of your original mortgage. So if you look at a mortgage of $100,000, you can make a $10,000 payment directly onto your principal every year without penalty. And you can also do what's called double up payments. So double up payments are my favorite. You can do a minimum of $100 a month up to double your monthly payment. Everything extra goes directly towards your principal. You can start and stop it at any time. You can increase it and decrease it at any time. So there's lots of flexibility when it comes to making additional payments onto your mortgage and being able to pay it back quicker as well.